Hello everybody, welcome to Friday, another Talk Money with Tom show. Today we are going to try to help you improve your retirement. We specialize in retirement planning, asset management during retirement, tax planning during retirement, in those areas. We like to do this through question and answer. And so you can send in your questions, you can send them in now. There's two different ways: the email address that's here on the screen, or you can do it in chat if you want to sign in on the YouTube channel. And we'll try to answer them live. Send them in during the week, and we'll try to answer them. Give a little bit more thought to them, maybe find some charts or what have you too. And then we get strategy sessions with our clients, and they come up with pretty consistent questions that we're getting asked, and so we try to answer those here in the show, just in case some other clients or other people that are out there have similar questions. And so we've been trying to provide this resource. We feel like there's sort of a gap in the knowledge base, especially around financial issues dealing with retirement. And that's whether you're, 20-something looking forward to retirement or 70-something already in retirement. A lot of these things apply for that entire spectrum, just things you should be doing to get ready for retirement, or things you should be doing while you're in retirement, how to distribute the money, how to allocate the money, those types of things. It's not the only thing in retirement. Health is probably much more important, family, those types of things. But having a good financial background and a good financial foundation, I think, can really help a retirement, make it much more comfortable, much more enjoyable. And so we created this channel. You can subscribe to the channel, talkmoneywithtom.com. And you go through the red subscribe button there. There's a little bell also if you want to get notified whenever we post new content. I think we have over 1,500 videos on there. I do a video every single day the market's open, pretty much, talking about what I saw happening with the market, help you learn some of the lingo and some of the things that are happening, and really what to watch for going forward. Even if you have an advisor, I still think the more you know, the better you do, right? And I've noticed that within my clientele also. And then lastly, of course, you can just schedule an appointment with Ethan and I. We're available. We have our appointment schedule online. You go to our website. There's a link to that here on the channel. There's a book appointment button, looks just like that you can hit, and then pick a 30-minute time to meet with Ethan and I. Come in the office, go, video or phone or whatever it is, and just ask us your specific questions that you might have, that you don't want to ask online here or what have you. So I hope everybody kind of enjoys the show today. Really looking forward to this. Hopefully you can grab just kind of one little nugget that you can use on each one of these shows. We will not be here next Friday. I was expecting to be here, but we had something come up, so we'll be here in 2 weeks. Yeah. Okay. So just so we get that out of the way as far as that goes. So, all right. So every week I like to start off the show with a summary of kind of what I saw happening in the stock market. As I mentioned, I do a video, every day about the market, but I try to do one for the whole week. For those people that don't want to watch it every day, they can just watch the Friday one and see what, happened this week as far as that goes. So let me get the screen up. Okay, so we've been showing this chart for a while. This goes back to 2019. This is a weekly data chart, so we can get a lot of data on one screen here. You can see the big 2020 drop, that happened because of the pandemic. And then everything was closed down. They were going around, trying to stimulate everything and sending out stimulus checks and pumping money into some of these businesses. The airline travel dropped 96%, for a while. And they overdid it. Let's face it. I mean, the economy was actually doing better than they thought. It was a bit of a panic situation, which we can completely understand. And we ended up with one of the sharpest upruns I've really seen. And so all of a sudden we had high inflation, peaked out, right? A very end of 2021. Beginning of 2022, they started raising rates quite dramatically, basically from 0 to about 5.25, in that range. And the market dropped 28%. Still higher than where we were before the pandemic started. So overall, the money that came in still created some value altogether, but it was a really rough ride. Peaked, bottomed out October 13th, 2022. Nobody thought that was the bottom, including us, even at that time. Although we weren't nearly as dire in our predictions, people still felt the market was going to fall dramatically from there. Matter of fact, Wall Street was dead wrong. We were following the trends at least and kind of hung in there and did quite well in that regards. But because I do believe that, you got to be careful about trying to predict where things are going to go. Mm-hmm. And that's the most common thing that you see on shows, articles, whatever it might be, people predicting where things are going to go, because that's what people want to know. I get asked all the time, what do I think about this? What do I predict? We believe much more so in a reactive environment where, we have a list of 181 ETFs. We just watch those and see which ones are moving up, and we're grabbing those as they come up, as that wave happens. And then as they start to fall backwards within that group, we have a cutoff line. We'll sell that. We'll buy something else. And what's a momentum trading? Basically, the concept is once something's in motion, it'll stay in motion for a period of time, and then you kind of ride that. And that's, most of what we put is just kind of in the market as a whole. And then we take this section and we do these targets, and we try to ride these targets and try to, outperform the market with that. And, we've had some success with that. But if you look at what's happened now, I mean, it's crazy. October 27th of last year was kind of the bottom of that 10% downturn that we're looking at there. And we've had, other than April of this year, where it's down 5%, you can see that little jag down, we've had a nearly straight up market. It's really incredible. And so if you can't have fun right now, you're not going to have fun as an investor. If you're worried about where things are going to go, that's probably okay. That's what keeps us honest. But still try to enjoy, somewhat so what's going on, because this market is being driven by, I think, sound concepts. It's not just some kind of mania. I mean, if you look at what's going on, inflation has subsided, good, still higher than they want, but they're talking about lowering rates much more so than raising rates, right? Expectation is 1 or 2 cuts. The Fed is kind of at 1 cut. I mean, this is not what we were talking about in 2022. It was how many raises we were going to have, and that's why the market was really struggling in that environment. You combine that with company earnings, which have been pretty good, especially in the bigger companies.
Yeah, the mega caps have been running heavily.
Oh, they've been doing really, really well. Matter of fact, the thing about these companies, they've been doing quite well as a whole across all of this time frame in terms of, even during the pandemic, your Apples and Microsofts and Googles and Amazons, they didn't always do as spectacular as you might want, but they've done really, really well. And some of them have done spectacular. And of course, then you throw in the artificial intelligence component here, which, seems like a hype and what have you. But when you look at earnings and you look at what's going on, I mean, Adobe had a 15% hop on their, earnings report because they were able to show kind of where they were making money off of artificial intelligence and where, more importantly, they were going to be making money off of artificial intelligence. Of course, NVIDIA was up 486% on their earnings growth in a 12-month period. That's a real number. This is now the largest company in the world on a capitalization basis. Did they fall back yesterday?
Yeah, they dropped to, I think they're second now.
Second now, okay.
Yeah, after the last couple of days.
But you don't see that kind of earnings growth.
Yeah,
that
they went from a $1
company.
trillion company to a $3 trillion company in less than a year.
Yeah, I mean, usually when you see those type of triple digit, in this case, mid triple digit earnings growth over a 12-month period, it's a small company, something that, they've just really got going as far as that goes. So great run. Momentum is super strong. I can stack up so many statistics as to why this is going to continue. It's not even silly. All kinds of different things that have happened. How much it gained in November, was 8.9%. When you have a month like that, you end up with a very much so an overperforming market for the next 12 months. I mean, over and over, even this year, when you have 10% or more in the first half of the year, you end up, with a very good year for the whole year on average. I mean, it's just stat after stat after stat that shows essentially what we believe in, which is that a body in motion continues in motion up to a certain point in time.
Yeah, and you're gonna have ups and downs. You're gonna have those Aprils where you're down 5%, or you're gonna have those short runs like last year where we had 3 months where we were down close to 10%.
That's exactly right.
And so you're gonna have the ups and downs, but overall the market's still going up.
Yeah, exactly. And so, I think one of the stats that's really kind of interesting to me, if you go back, to the 1920s, the average bull market, up market, in case you don't know what bull market is 3 years, okay, give or take. And we started this in October of 2022. We're roughly a year and a half, a year and, 2/3, however you want to look at into that. If you look at the bull markets since 1970, since the Federal Reserve and the Congress and different things, they started figuring out kind of how to manage the markets a bit, especially since 2008, man, they started all this money coming out and what have you. We're talking about a 5-year average bull market run in that time frame. And so obviously, just again, another stat that shows that there's some potential for long term. Now, there's always something out there like a virus, right? We were on a pretty good run in 2019, dead stop by that virus, right?
Yeah.
So whatever it might be, there's always something out there. It's always something you have to be aware of. And it's why we watch our universe of ETFs and we say, okay, what's moving? And, usually you'll start to see some creep and you'll start to see some things kind of coming through as kind of, warning signals as far as that goes. And so when we look at kind of what's happening right now, so this is something, there we go. This is something we started last week. Now the dates are when we had our last change. Okay, so not today or whatever, but this is the last change for these. So the hourly, daily, weekly, and monthly charts on the S&P 500 are all showing that the primary direction is up. Okay, now the hourly one changes much more frequently, obviously, than the daily, and I wouldn't pay too much attention to it, other than we use it as an entry point for new money that comes in. So if it's green, we'll continue to buy as the new money comes in. And when it's red, the primary direction, at least on a short-term basis, is turned down. We'll wait until that turns back up again, just in case, right? Because the next big downturn will start with the hourly. But it's sort of it happens too often to really, trade on or do any of those types of things. The daily is much more important. Actually, a daily primary directional down change, downtrend, going from primary up to primary down is actually a pretty big deal. So when that turns red, we start to get real serious. And obviously we'll see a lot of change within our ETF universe. We'll see much more defensive things coming up by that point in time. So for example, if we go back to this chart, when you look at this downturn, the 10% downturn that happened last year, we stayed in because the daily was still green, right? The primary direction was still up. And I'm really glad we did. The market jumped 5% off the 27th of October really fast, in a week or less. And it was up 8.9% in November. And so that's why, now the primary direction comes from Charles Dow. This is from the 1800s, right? He's the founder of the Wall Street Journal. This is a really study of his writing. That's called Dow theory. He didn't make it per se. That was made later after he actually passed away, but it's from his writings. And so this has been around for a long time. It's just a way to look at highs and lows and the direction of the market. You can study, Dow theory. Pieces of it are dated, like, what's happening with transportations and things. We'll talk about that in a minute. But essentially what we're looking at here is a primary direction that's up. It wasn't violated in that downturn in 10%. We rode through that, and I'm glad we did because things are going quite well right now. So we'll show that, when things are happening, so you kind of can tell what's going on. Also, you look at that and say, hey, it's strong. Right? If you look at the first four boxes, this market's strong. Okay, good. Then we look at breadth. Now, breadth is not, and I had some questions about this because we presented this last week. Breadth is not an early indicator, warner. You go back to some of these smaller downturns and you'll see them all green, right before it turned down. That's not what we're looking for here. On some of the really big downturns, you'll see some more deterioration. So when we get to the peak in 2000 or the peak in 2008, you will probably start to see some breadth deterioration, some narrowing of the market as it's about to keel over. Obviously, that's not happening now. Everything's green. What I look at this for is in those smaller downturns, when we are starting to have that 5 or 10% downturn, how many of these things are starting to turn red? Should I be more concerned? Even though we're still in the primary direction that's up, let's say, from end of July last year to the end of October last year, how many are starting to turn red? And how many things are we looking at there as far as that goes? And so there's only one red one here. It's transportation. Transportation was part of Dow theory. And the idea was that transportation led the economy. Because back in the 1800s, there was no digital economy. Everything was physical, right? It went through a train, and what have you. So if you watch those stocks, if they started to deteriorate because of, dropping volume, essentially, then that could be an early indicator. We still have a lot of physical goods that make up this economy. So it's still somewhat accurate. But right now, the money's being made in areas, they don't need a train to deal with artificial intelligence per se. And even the semiconductor chips don't take up much space in a cargo hold of an airplane, those type of things. And so still Still, it's down a bit. We'll see what happens. Does that mean anything or not? But this will be kind of an interesting exercise to take a look at on a regular basis. But I will say right now, obviously the market is super strong. I presented this chart last week. I just wanted to present it again because we are heading into a seasonality right now that's quite important, okay, to understand. So even though the market's doing quite well, it could do better here. Maybe not for long, but for a little while. So if you look at the kind of the best months, so first of all, it says how many months on average are up. So 75% of July's,
a
positive going back to 2004, okay? So it's a good month. That's what's coming. Here we are, sitting on the 21st. We're looking at July. But the average rate of return is actually the second highest, right? November, interesting enough, is the highest. 2.5% average, again, on the S&P 500, 2.4% in July. But I want to take this one step further, what they're calling the wall of money that's coming in. And so it's all of these passive investments that come in and they get rebalanced at the end of the quarter and the end of the half of the year, which actually happened to coincide with June 30th. And so I got this chart from from Bloomberg, and it's hard to see this a little bit, but first half of July has the best rate of return of any 2-week period or any half-month period, however you want to look at that, right? The worst is the second half of September, which is kind of interesting as far as that goes. But if you look at kind of what's going on, look at that, the second half of December, the first half of April. A lot of people credit that first half of April with all these IRA contributions coming in and what have you. I don't know if that's true, but it has been a good time frame. The first half of January certainly was true this year.
Yeah, it's very common in January where people sell out in December and then they buy back sometime in January.
Yeah, exactly. And so that's coming at us, right? And so one of the highest average rates of return months of the year, combined with the highest 2-week period. Now, this is going back to 1928. So this is significant data looking back over a very long period of time, the first half of July. Now, the market tends to get softer after the 17th of July. Where's the second half of July up there?
Oh, it's right in the middle.
So it's a zero, okay? So maybe we make all of our money in the first half and then we scoot through the rest of the time frame. I do think there'll be some interesting things happening in July because the Federal Reserve meets again, and sometimes the market gets a little rocky around that. We got the Fed minutes that come out from the last meeting. Usually, the market is okay unless they start like last time talking about some rate increases. Maybe they won't this time. We'll see what happens, but. And we're going to head into maybe a softer period here in September. Both the first and second half of September are in that bottom piece. And if we go back to the monthly, September is a negative 0.06%, right?
Yeah.
Up 60% of the time, so it's up more often, but the overall return is slightly down, right? So I do think there's some seasonality here that's important to pay attention to as far as that goes. And really, right now, I think we're in for a continued run. Like Ethan says, even in the best markets like we're having now, we still had a 10% downturn last year, even though the market was up over 25%. We've had at least, 1 5% downturn here. Wouldn't be surprised to see something happen. We're going to head into election. I got a lot of clients ask me about the election and, worried about that and what might happen and, those types of things. And September is right there with its negative seasonality. And people might say to themselves, hey, I'm just going to wait and see what happens. And I think that happens every election, actually, even one that's not as contentious as this one. And that's why you often see November. And you see, if you look closely, the first half of November is actually up on that list.
Yeah, that's one of the better ones.
Probably partly because of the every 4-year presidential election and that it's known, we know who the president is, we know what the Congress makeup is, and that money that was delayed coming in kind of floods back in. Just my theory, but I've seen consistently throughout my career a very good run right after the election, no matter who's elected.
Yeah, there's going to be half the country just kind of happy,
Yeah.
So you're going to have that run up.
Yeah, and it's just delayed money coming in. And so, the one thing that could help September, that's where the market is really focused. Maybe it won't help because it might not happen, but it's really focused on a Fed rate cut.
Yeah.
And so if we have one, I think the market would respond positively to that. If we don't have one, it'll probably just exaggerate, the situation, the presidential election. And again, I've mentioned my outlook on the election. Just in my experience throughout time, first of all, the market responds the most negatively to the unknown, the thing that we're not talking about.
Mm-hmm.
Okay, so Lehman Brothers going out of business, 100-plus-year-old company, folding up, and not knowing that there's $7 trillion worth of credit default swaps. These are insurance policies on top of mortgages that are all going to come due because mortgages are failing at a rapid rate because they were giving them out to anybody, right? None of that was known. I remember the Treasury and the Fed are, pushing on Lehman and stuff, and they didn't want to bail them out. They just bailed out Bear Stearns, and they didn't bail out Lehman. They were upset with the CEO. I think in hindsight, the $150 billion they would have cost to bail him out would have been a lot less than the $7 trillion we spent after that to try to bail out the whole country. The market dropped 32%. So that's a good example. Whereas, when it's a known thing, I can't remember a single instance where the market has dropped substantially about something that's known. And my analogy still stands where you're walking down a dark street, there's a big hedge, somebody jumps out from behind that hedge, you're going to respond negatively because you weren't expecting that. It's scary. If on the other hand, somebody's behind the hedge and they might jump out, when they do, not nearly as nervous. And so those things tend to get kind of baked into the market. Again, I haven't seen anything happen. And it also has to have some economic impact. And you could make an argument that the election and who's in Congress and who's in president has an economic impact. And there is some issues there. But it's more of a longer term thing if there is something, and there's sometimes goods and bads.
If they're going to do any kind of economic, their executive orders or kind of bills, which don't happen instantly. They take time to be pushed through.
Yeah. Remember, it wasn't that long ago. We had massive protests over Black Lives Matter, over George Floyd, 26 million people involved. Market went up during that entire time frame. And then we had a January 6th, whatever you want to call that, invasion of the Capitol. Market went up on January 6th. Market went up on January 7th. And so it really has to have some impact on earnings, on company earnings. And neither one of those did in the end across the board. Certainly there's some things that happened, but so that's kind of something to think about just in terms, because I got asked that, all week this week in my different appointments, what do I think is going to happen with the election? So I'll just keep putting that out there. That's not my main concern. My main concern is really what the Federal Reserve is going to do, how earnings are going to play out, what's happening with this artificial intelligence picture, and mainly how inflation comes through. The economy's pretty hot. I know a lot of people don't think that, but it is. As a matter of fact, if you look at all the big domestic countries out there, we've had the highest gross domestic product growth of all of them by a long shot since the pandemic. So certainly on a relative basis, we are the envy of the world in that regards. And so, that means that people have money, earnings are growing faster than inflation's growing, the stock market's going bananas, housing prices are going up, household wealth has been growing at a very fast rate. I think the threat is inflation, and a resurgence of inflation. So I don't know that that's going to happen, but that would be the thing I'd be more concerned about than what happens with the presidential election, at least from the stock market standpoint. There's lots of other things to worry about from the elections, but I don't think the stock market is going to have a significant trouble with what happens. Could be wrong, And we don't react on predictions. I'm not going to make changes based on what I feel about the election. We're going to look at our universe of ETFs, and if very conservative things start to move up, then we will be moving into those. And our other things that we have moved down, then we'll move out of those. So, it's pretty self, predicting as far as that goes as to where we go. So anyway, I think this is a great time to be talking about the stock market. We spent a little bit more time on it today than normal, but I think it's worth understanding what's happening here and kind of embracing what's happening here, because this is where you can make money. And so anyway, look forward to being able to talk to you about this again in a couple weeks. I won't actually be able to do my summary next week. Again, I'll be out of town unexpectedly, but I will certainly do this again in 2 weeks. All right. What do we have for our first question?
So how would you use market breadth in trading? How are you using it as a confirmation signal if it's not like
Yeah, so market breadth just means, how many stocks are participating, how many stocks are hitting new 52-week highs, how many categories, like we talk about in our summary of stock market, are in a primary up direction. There's lots of different ways of measuring market breadth. Market breadth has a lot to do with health of current market. And so, for example, you could be at a peak health standpoint, right? But there are a few things, that start to deteriorate, and they're very small. Maybe you don't really notice them. And so what you're looking for with breadth on the upside is you're not going to see it as an early warning indicator, because it's still going to show, hey, I'm pretty healthy, like it is right now. Everything's green. But what I look at it more is for just, hey, as that thing starts to turn, as we start to end up with this 2, 3, 5, 10% downturns, how bad is it, right? So, you can start to feel poorly, but it could just be a flu, or it could be something much worse. Yeah. And so breadth is really just, how bad is it? And then, because the worse it gets, the more chance it has of turning into a 20% downturn or more, right? So that's how I look at it. I want to see it's just the opposite on the other side. How good is it, right? How good is this? So, well, yeah, I still got a lot of red on here, so I'm kind of wondering if this rally has enough steam to keep going, if I've got a lot of red on the different segments of the economy and the primary trends are not up in those segments, versus, hey, it's mostly green. Hey, this is good. This is a healthy market motion upward. So it's much more so a confirmation of what's happening, and maybe just from interest standpoint to see what's going on. We don't really respond to it per se. It's sort of just an informal advisor as far as that goes, because again, we have our universe of ETFs, and we're very strict with that, and we are sticking within that universe. And if those things are moving up that we've approved to put in our universe, and other things that we have are moving down past our cut line, we're going to buy those things moving up, and we're just going to keep on going with it. And sometimes those things moving up are defensive, right? And so breadth would kind of confirm that. Okay, it just makes me feel better. Hey, we're moving into these more defensive areas, but look at the breadth, it's pretty bad. Right? Yeah, we're down 5-10%, but the breadth's pretty bad. We're still in the market, but now we're in more of, high dividend paying stocks, utilities, maybe a little bit of T-bill exposure, just to kind of dial back the risk, at least on our target pieces, And so that's how I look at it, just from the standpoint of, confirmation for where we are in the trend. Because right now, we're buying a lot of technology because that's what's really running. And you think, okay, how is that going to work out? And you look at it, well, the breadth is really good. It makes me feel okay about it at the moment, and it's worked quite well. So anyway, that piece of it, you throw in seasonality. There's lots of pieces that kind of make this collage of, how you want to look at the market, at least from a mental standpoint. And so I think breadth is a piece of that. So yeah, I think it's important from that standpoint, and I always find it very interesting.
So with 6 companies making up 31% of the S&P 500, am I diversified if I'm using, index funds?
Yeah, so let's say you buy the S&P 500. We have VOO highlighted in our weekly summary there as one of the segments that we watch. That's the Vanguard S&P 500, ETF. And so what they're doing is they're buying those 500 stocks in, almost exactly the same percentages that are on there. And so there's 500 stocks, and 6 of them make up 31% of the value of the index. And so what happens is the way that they do these indexes, they're market cap weighted. All right, you can do equal weight, where you'd buy, I think it's 100 divided by 500,
So a quarter or a fifth of a percent.
A fifth of a percent each, right? So there are equal weighted ETFs out there where you just buy an equal amount of every single stock on the S&P 500. And we watch that quite often, because that is another breadth indicator, actually, as to how things are going. But certainly what we're seeing right now is a group that is leading the markets because they're just doing so well. And so a couple comments, in my opinion. When you're looking at the S&P 500, first of all, 69% of the index is still in other stocks, right? You're not buying 6 stocks. That's a little different. And the 6 stocks change. That's really important to understand. At least in the top 10. I mean, Tesla was in the top 10. They're probably not anymore, I would assume. But look who's moved up in the top 10. NVIDIA's in the top 10. Eli Lilly has moved into the top 10. And so that's one advantage of an index, right? You're kind of, you don't have, if I buy those 6 stocks on the open market and put 31% of my portfolio in it and Tesla falls apart, I have to, deal with that. When I buy the S&P 500, it kind of deals with it on its own. All of a sudden, I will have more exposure to Eli Lilly, which has maybe the drug of the century with Mounjaro, and Nvidia, which probably has the business of the century with this artificial intelligence chips.
At least for the decade.
Yeah, I've never seen 486% growth, never in a company ever. I've been doing this for 37 years. I'm sure there's something out there that somebody could find, but I didn't see it. So I'm very impressed. And so that it kind of takes care of itself. It's like a race within those 500 stocks. And the market is telling you which ones are doing best by buying more, driving up the price, increasing the capitalization, and then you're capturing that on the way up. I think that's awesome.
Yeah, because it's not, these indexes are just following the market capitalization. So the market's valuing this company higher than the rest of the market.
Right.
And so that's how it's kind of growing. And there's an ebb and flow. There's periods of times when, the top 6 or top 10, only make up 20 to 25%. So it'll flow up and down just based on how the market's doing.
Yeah, exactly. It takes care of itself. If the money starts rotating to mid caps, and a lot of them happen to be on that S&P 500 index, you will gain from that without having to move. Maybe those top 6 stocks start to do poor, but maybe some of the other pieces rotate up and start to do okay, your overall index. So you actually have 500 stocks. And yes, you have some narrowness right now within that group. That doesn't really bother me because, again, there's a rotation that can happen on its own, and you're letting the market tell you. And so here's some other pieces I think are important. Number one, those companies are awesome at running their business. Mm-hmm. That's why they're so big. Even during the pandemic and all of the things, these companies continued to make money. Unbelievable. I mean, these are the greatest companies in the world. They're certainly in that group of greatest companies in the world. And the S&P 500, I think, is unique in the sense that it's the representative, I think probably best representative of the U.S. stock market. And so if you're an international buyer, big pension manager, what have you, you're buying the S&P 500 with a portion of your money because there are a couple things there. First of all, you're standing in front of a cash flow, an international cash flow that just continues to come in. But the S&P, Standard & Poor's, actually selects those stocks. There is a group that has a criteria for how these stocks, it's not just any stock that gets on there. They have to have earnings for a certain number of quarters, a certain amount of earnings, and then they knock some companies off and put companies on. So they are automatically kind of managing that group. And so it's a select group of stocks. It's not just random. It's not the top 500, that type of thing in terms of size. Although mostly it is, it still isn't completely. So I think that is another aspect of that all of which trumps the narrowness of it. And heck, right now that narrowness is paying off.
Yeah, the exposure to Nvidia, Microsoft have been massive for a lot of these people.
Yeah, what the heck? I think it's a good play. So anyway, it's a very good question. It's valid. I actually got asked that question this week in one of my strategy sessions with a client, and by the time I was done explaining it, they were pretty excited about it. But look at the S&P long term. It's a really good index. It's done really well. I've been very impressed with it for years, and we've been buying it as an ETF since late 90s. And we have some people with some gains that are just ridiculous. So I wholeheartedly like that index or other things like that. It's not just the S&P. I still like the total stock market index with the Vanguard, which I think is really great. It incorporates all the stocks and what have you too. But the questions about the S&P, and I still think it's worth looking at as a piece of a portfolio. There's nothing wrong with what's happening there, in my opinion.
So is there a limit to how much money I can withdraw from an IRA? I know we have RMDs that kind of set a minimum that we have to withdraw, but is there a maximum?
There's no maximum that I can think of other than what you have in your account. If you have 100,000, you can't take out 110.
You could say maybe put a limit on how much money you can do per transaction,
right?
But
I don't think we've ever hit that limit. Whatever it is, probably $500,000 or something at Charles Schwab. I don't think we've ever had anybody take that much money out. You know, people roll it over, do
Yeah.
different things, but actually withdraw and have a $500,000 or more taxable income on your tax return. I can't think of that ever happening within our practice.
Yeah, because with an IRA, taking it once you get to a certain point, it becomes very expensive to withdraw
Yes.
the money
Yep.
because it's all considered ordinary income, and so that's why you don't see the kind of these big withdrawals very often.
Yeah, exactly right. That's what keeps you honest on, you know, wanting to withdraw it over a period of time instead of all at once. You know, because the 37% tax bracket on the Fed side and the 13% here in California state bracket comes into play when you start to pull out that kind of money,
Yeah.
and all of a sudden you got 50% of your money disappearing. That doesn't make any sense whatsoever. And so people are generally common sense about these things. And again, you know, we're here to kind of advise on those too and figure out ways to reduce taxes and still meet the needs, you know, of the withdrawal. You're in retirement, you're trying to live off of this money, you know, you're no longer adding to it. So you definitely need to pull money out. But how to do that and where to pull it from first, what we call the sequence, the optimal sequence of withdrawals is a really important component of what we offer to our clients. Because you've got to be really careful with where you take the money from first, second, third, and fourth. You mix up the order, you will dramatically impact your retirement. That's a fact. And a lot of people don't know the order, and that's what we're here for. So, you know, don't be taking huge amounts of money out of your IRA, but you can, you know, hey, if it's a small dollar amount and you just want to liquidate it, that makes sense. Fine, right? Just to get rid of it, whatever it is. Maybe you inherited it and you just don't want to deal with it. You have to keep it as a separate account. You don't want to deal with that. It's $10,000, you know, cash it out. You know, it's not going to affect your tax return that much. So that's fine. But in terms of, you know, bigger dollar amounts, be careful.
So should I start to lock in longer term CDs now that we kind of are at a point where we don't see interest rates going up unexpectedly?
Yeah. I think it's a good question. The Federal Reserve, in their dot plot in June, projected one rate cut this year, and what, 3 or 4 more next year, 3 or 4 more the year after that. So the Federal Reserve, even though they have 400 economists on board, they're not always right either. As far as that goes. The market was expecting 6 rate cuts this year, and now down to 1 or 2, depending on what day it is and what report has come out.
Yeah.
But all of those are talking about lowering rates and not increasing rates. And so, yeah, I would definitely be looking at least a little bit longer term on a CD, just because the probability is lower. Although I don't know that I'd go crazy, just because the economy's good, the stock market's good, the housing market is good. Those 3 things can stimulate consumer behavior. We could still have some inflationary numbers coming through. Now, the last 2 months have been better than the first 3 months of this year. So that's good. Makes me feel a little bit better. Market is settling in on that also. But we could have a resurgence in inflation. If that happens, then of course CD rates would go up. So I'd probably still keep, you know, something in that kind of 6 months being short to 24 months being long. Once we start getting, you know, closer and we see a few more of these, you know, reports coming through, I might go past 24 months, that 36-month period. I like ladders. I mean, I do 3-4 pieces, divide it up by 3 or 4, and have them coming due as far as that due. But I probably extend my ladder. If I had a 1-year ladder right now, I'd have a 2-year ladder going forward. I'd probably get to a 3-year ladder, maybe even by later this year, once we see some more inflation numbers come through. Because I do think you'll be pretty happy with a 5%, you know, I don't know, can you get 5% on a 3-year? Maybe not.
I don't know if you
Even
get
if it's
5.
4.5, right? Because that could drop quite a bit in 3 years if rates go the way everybody seems to be projecting. I don't think you'd be upset with that if your 4.5%, you know, 3-year CD came due and the next 3-year CD was at 3% or something along those lines. So, yeah, that's how I play that. We've been talking about that for a little while.
So why does it take so long for shelter-related inflation to slow down? You know, we've talked about how rents and, you know, just home buying has been so expensive on the inflation scale.
Well, a couple things. First of all, if you look at the CPI, Consumer Price Index, that's the one most people know about. It's not the one the Fed pays as much attention to, but CPI uses what's called owner's equivalent of rent. Okay, there's a whole bunch of reasons for this. This is interesting. So owner's equivalent to rent is they look at it and say, how much would you have to pay to rent your own home? It's kind of controversial, to be honest, because the calculation seems to be a bit out there. But if you look at what's happening with rents, we've got 7%-ish mortgage rates. That knocks a lot of people out of the housing market. The number of new listings has dropped down, so there's less supply, because nobody wants to give up their 3% mortgage. And so the housing market cost to buy has been pretty high. And so if you can't buy, then you need to rent. And so there's a higher demand for renters because interest rates on mortgages went up. And then you combine that with the fact that rent is delayed anyway, because who rents month to month?
Not very often.
I don't have any clients renting month to month on any of the rentals, right? Year, 2 years, 3 years. So you signed a lease, it's going to be a fixed all the way through. And they're looking at that as part of the calculation for shelter costs. It's not going to drop until that lease comes up. And so
it's pretty uncommon for rents unless you're in a market where, to like fall substantially. So you're going to see some decrease, but you're not going to see a massive, because these people bought in and now the owners want to still maintain their profits.
During the pandemic in like San Francisco, we saw rents drop, right? Because the tech businesses were all allowing everybody to work remote. And people, the young kids are living up in San Francisco to experience San Francisco, the nightlife, the clubs, and none of those were open. And so why pay high rent when they could go live in Idaho or wherever for cheap and, explore the outdoors? And so, but that's a pretty extreme scenario. And I think Easton's right. We don't see rents coming down that often. And the other thing is that, when rents pop up, it takes quite a while for new supply, new rental units to be built.
Yeah, it's not a quick thing, and the pandemic kind of was a perfect storm for draining the supply. You had people that weren't spending as much money on other things. You couldn't travel, you couldn't go out and spend at restaurants as much, and so people had extra money, and then interest rates were so low, and so you kind of had people just eat up all the supply, and then supply coming back onto the market has been very slow.
Yeah, and it'll probably adjust over a period of time, and if they build a bunch of apartments in places that aren't impacted, like these high-cost cities, then it doesn't really help the supply of those high-cost cities. And if you look inside these high-cost cities, it's extremely difficult and very long process to build, because they're usually building on top of something else that was there that they have to acquire, tear down. Like in South San Jose, Google is putting in a whole kind of Google village. Well, man, they're having to buy up all kinds of property. There's no open land there per se. They're buying old homes that they're going to tear down. It takes time. And, they're going to put in, I think 20,000 units or something. That should help the supply. But the years it's going to take to kind of get that through is going to take some time.
There's a lot of bureaucracy with each city kind of sets, you have to have a certain amount of lot space. And you can't have
parking, right?
Zoning. Right. How many can you have multiple homes on this? And so they're starting to, as a way to get more housing, is to kind of lower the regulations and red tape. And so that's what we have to see too, is that if you want to lower this and fix inflation, yet more supply has to come onto the market.
You need more supply, and that's how they're trying to deal with these high-cost living areas like here. Like they're allowing these ADUs in the back of homes that they didn't allow before. Ironically, they allowed them a long time ago, then they outlawed them. And now that they realize there's a restriction on, the number of homes and people are having to travel from, really far away to come work here, they're putting in these ADU concepts. And we got a lot of clients that are going after that and putting in ADUs behind their homes. And basically you provide more density into an area by allowing, more big apartment complexes, condo complexes, whatever, to be built. And so that is happening actually, but again, that takes time. And so there's a lag on everything.
Like near my parents' house, there's an old strip mall, and what they're basically doing is they're going to demolish that strip mall and make it into kind of a mixed use with stores and housing. And so those developments aren't easy or quick to build. They're going to have a multiple year building periods.
How long have they been working on that already?
The townhouse is at least 2 years.
Yeah.
So.
They're probably a ways away from getting there too. So anyway, it's a great question. It is what kind of makes inflation sticky, at least in the numbers. It is an important component of inflation. I mean, it's something we all pay. It's
It's
for
pretty
housing.
heavy weighted too,
Yeah,
because it's
yeah.
such a big cost of
Yeah,
living.
it is. It's legitimate. And, it's very hard, though, for the Federal Reserve to really affect that with rate increases, per se. Matter of fact, you can make an argument they're making it worse. As they raise rates, mortgage rates go up, less people can afford homes, and so more people are chasing after the few rental properties that are available. And so sometimes you get a backward consequence out of what's happening with raising rates. We're certainly seeing some of that here, at least in that area of shelters. So. All right. Well, that's our show for today. I want to thank you very much for coming. There's some great questions today. I think there was some good pieces that people can grab onto. Send in your questions for our next show 2 weeks from now. And love to be able to, help you with those. You can send them to asktom@talkmoneywithtom.com here, as you can see on the screen. Subscribe to our channel. Up your education level in these areas. You will be very satisfied, in terms of your potential financial retirement. And then hit the bell button to get notified when we put new stuff out. And then if you want to schedule an appointment with us, there's a book appointment button up in the corner of our website, and you can set up a time with Ethan and I, that works for you. So look forward to seeing you in a couple of weeks, and thank you very much for joining us today.